Monday was a crazy day for the semiconductor market. We can see AMD was down roughly 3%. Your favorite semiconductor, Intel, was down roughly 4%. My favorite semiconductor, Nvidia, was down roughly 4.5%. We can also see Micron Technology down 3.6%. But it's not just the semiconductor market. We can see the overall Qs were also down roughly 2.6%. And one of my favorite semiconductor ETFs was down 3.5%. So like many of you know, and if you don't, I'm super bullish about the semiconductor market. And today I want to show some pretty cool graphs that might surprise you about why you should also be excited about semiconductors and chips on dips. Get it? Chips on dips? Well, let's get started.
I do want to thank The Motley Fool for sponsoring this video, and make sure to check out fool.com/Jose to get the top 10 stocks to buy right now.
I do want to say right now the semiconductor market has its fair share of headwinds. The first one is, hey, the consumer market, which a lot of these semiconductor companies are dependent of, to some extent might see a slowdown due to the overall kind of consumer spending going down. The second thing is, with interest rates going up, companies are expected to spend less money on future investments, and some investors are worried that, hey, they're gonna cut down their investments in semiconductors, in chips, and in the technology they need to innovate. And that makes perfect sense, right? And the third thing is, the past few years we've seen this huge kind of demand outweigh supply, and many are fearing that that era is ending soon, and now we're going to come to a point where supply is much higher than demand. And we are seeing that in things like the memory market right now. And I know many of you guys might not hold semiconductor stocks because you're worried that, hey, this is such a hard market to understand, and that's why I usually tend to look at ETFs. Even for me, someone who understands this market, I'm still willing to get into semiconductor ETFs. So for those not familiar with SMH, this is one with 25 holdings and an expense ratio of roughly 0.35. Not the worst thing in my opinion. Right now we can see their top 10 holdings, which I think is pretty impressive, make up over 50% of the total portfolio. And we're actually going to take a closer look at 9 of them right now and look at some pretty cool charts. We're going to look at TSM, Nvidia, Texas Instrument, Broadcom, ASML, Advanced Micro Devices, Analog Devices, Cloud Corporation, and Intel Corporation. So I want to first showcase the overall revenue growth these companies are seeing. In the past quarter, year-over-year growth has grown double digits for 8 out of the 9 companies. The only company seeing a bit of the decline right now is Intel. Also, if you are enjoying the episode, make sure to hit the thumbs up, as it does help me grow my overall audience. And if you want to support a little bit more, make sure to subscribe using my link at fool.com/Jose. Now, some of you might be like, hey, Jose, the semiconductor market right now is still pretty good, but in the upcoming quarters, we are expected to see a decline on their growth. And that might be true. Here, I'm taking a closer look at revenue growth estimates for the upcoming quarter, and 7 of the 9 are expected to grow. Obviously, the growth is not as big, but 6 out of the 9 are actually expected to grow at double digits. One of them is expected single-digit growth, and 2 of them are expected to decline compared to a year ago. One of them is Intel. Again, we understand why, but the other one is ASML. And I do want to say with ASML, it might not be as bad as you think. It has to do a lot with kind of their revenue recognition. And you might be like, okay, Jose, analysts might expect them to grow one more quarter, but if we take a closer look at the full year, most of them should be seeing a decline. And here we can see 7 of the 9 are actually expected to grow on their current fiscal year. Only 2 are expected to decline, Intel and ASML. Again, I mentioned why ASML is expecting that revenue decline, but things are not bad like they seem. This is a company still selling record numbers of equipment to their customers. Now you might be saying, okay, Jose, it is true, but if we take a closer look, these companies are spending too much money and have not improved their cash flow from operations. But if we take a look, 7 out of these 9 companies have seen an improvement in cash flow from operations in the trailing 12 months. So that's positive thinking. Next, you might be like, Jose, all of these are in big tech companies and they're just kind of diluting shares. But if we take a closer look, since the past 3 years, 6 out of the 9 have decreased their diluted shares by over 2%. Nvidia is only up 2% compared to 3 years ago. And then we have Analog Devices and AMD with a huge increase in shares, but this is mainly due to overall acquisitions that they have made. And then you might be like, okay, Jose, things aren't that bad, but if we take a closer look at maybe some of their valuation metrics, most of these are sitting at very expensive levels right now. And if we take a closer look, actually 6 out of the 9 are sitting at below this valuation they were sitting 3 years if we take a closer look at EV to EBITDA ratio. Only 3 of them are higher than 3 years ago, but a 20% growth is not that huge. Let's say if it was previously a 10, now it's a 12. Not a dramatic growth and doesn't really show that overvalueness in my opinion. Next, you might be like, Jose, actually you're right, but I'd rather just invest in the S&P 500 because I'm pretty sure most of these have not outperformed the market. And that's not the case. If we take a closer look in the past 5 years, 8 out of the 9 have outperformed the market dramatically. Only 1 has missed, and this is taking a closer look at total return, so it does include dividends. There's only 1 that has underperformed the market, and that is Intel, your favorite semiconductor company. And then you might be like, well, of course they have outperformed the market. If we take a closer look at these past 2 years, the overall kind of demand in chips has increased dramatically, pushing stock prices up. All right, so then I decided to take a closer look at between 2015 and 2020, pre-COVID, so we can't see this overall semiconductor shortage. If we actually take a closer look at that time frame, all 9 have outperformed the S&P 500 when we take a closer look at total returns and by dramatic values. But then you might be like, Jose, I can't hold these semiconductor companies. I don't know what they do. What would you kind of say I look at instead? Like I mentioned earlier on the show, that semiconductor ETF SMH, those were 9 out of the top 10 holdings at the moment. If we take a closer look in the past 10 years, the VanEck SMH ETF has outperformed the Qs and the S&P 500 dramatically. If we take a closer look at the past 5 years, the numbers are still the same. The SMH semiconductor market continues to outperform. 3 years, nothing has changed. In the past year, now things are a little bit different. They are a little bit tighter. And if we take a closer look at year to date, right now the VanEck is actually underperforming the S&P 500 and the Qs. And I do believe if this can continue that strong growth over time, and definitely so, we have numerous tailwinds in the semiconductor market, I believe there is huge opportunity in semiconductors right now. So if I didn't want to hold individual semiconductor stocks, I would 100% be holding SMH, no doubt about it. And I actually do. So I hope you guys enjoyed today's episode. I just wanted to showcase why I'm still super bullish in the semiconductor market. Like I mentioned, this is a market that is still in early stages, especially with all the tailwinds that industry has and the technology has, from artificial intelligence, autonomous driving, fintech, data centers, video streaming, social media, and the list goes on and on. Thanks for watching. Take care, have a good day, and see you next time.